In the spring of 2022, Michael and Chris were in almost identical situations. Same city, same income range, same age. Both had spent years saving for a down payment. Both were tired of renting. And both had their eyes on nearly identical homes. The houses weren't luxury properties, no swimming pools, no custom kitchens, no dramatic views, just ordinary family homes in ordinary neighborhoods. The kind of houses millions of Americans buy every year. Each cost around $385,000. Each required roughly the same down payment. And each came with the same problem. Mortgage rates had started climbing. Fast. The average 30-year mortgage was sitting near 5.8%. Higher than people had become accustomed to. Higher than the ultra-cheap money of 2020 and 2021. And according to almost every headline at the time, rates weren't supposed to stay there. Economists expected relief. Housing experts expected normalization. Forecasts suggested lower borrowing costs were eventually coming. So Michael bought. Chris waited. At the time, both decisions sounded reasonable. Michael's argument was simple. Nobody knows where rates are going. If the payment works today, buy the house and move on. Chris had a different view. Why lock yourself into a high rate if a lower one might be just around the corner? Why rush into the largest purchase of your life? Why not wait 6 months and see what happens? 6 months felt harmless. Maybe rates would ease. Maybe prices would cool. Maybe buying would become easier. So Chris stayed put. The plan seemed cautious. The plan seemed logical. The plan seemed temporary. Then something happened that almost nobody plans for. Time passed. 6 months became 12. 12 became 24. 24 became 36. And before Chris realized it, 4 full years had gone by. Today, both men still live in the same city. Both still drive past the same neighborhoods. Both still remember the houses they looked at. But only one of them owns one. And that's what makes this story interesting. Because this isn't really a story about houses. It's a story about assumptions. Specifically, 3 assumptions that sit underneath almost every wait for rates to drop strategy. Most people think waiting is a bet on one thing. Mortgage rates. But that's not actually true. Waiting is a stack of bets. A bet that home prices won't run away from you. A bet that rates will eventually fall. And a bet that they'll fall enough to make the entire exercise worthwhile. Miss on any one of those and the math starts changing. Miss on 2 and the strategy can unravel surprisingly fast. The problem is that very few people ever write those assumptions down. They simply wait. They assume conditions will improve. They assume tomorrow will offer a better deal than today. And sometimes they're right. But sometimes they're not. Which raises a question worth asking. What would actually need to happen for waiting to win? Not emotionally. Not politically. Not theoretically. Mathematically. Because now we have something most personal finance debates never get. A completed experiment. 4 years have passed. The results exist. The receipts are sitting on the table. And for the first time, we can stop arguing about what might happen and start looking at what actually did. We're going to follow both paths. We'll track every major assumption, every major cost, every major benefit. And by the end, you'll understand something far more useful than whether Michael or Chris made the right decision. You'll understand the exact conditions required for waiting to outperform buying, and whether those conditions are as common as people think. Let's begin with the assumption that causes the most damage when it's wrong. The assumption almost nobody talks about. The assumption that the house itself won't become more expensive while you're waiting for the loan to become cheaper. At first glance, that assumption sounds perfectly reasonable. After all, if you're waiting for mortgage rates to fall, you're focused on the mortgage, not the house. The rate becomes the headline, the thing you watch, the thing you talk about, the thing you refresh on your phone every week. But the rate isn't the only number moving. The price of the house is moving too. And that's where many buyers accidentally make a second bet without realizing it. Chris certainly did. In his mind, he was waiting for cheaper financing. What he didn't realize was that every month he waited, he was also betting that home prices wouldn't climb enough to erase whatever savings a lower rate might eventually provide. That distinction sounds small. It's not, because one of those variables moves your monthly payment. The other changes the entire transaction. Let's see why. Imagine a house selling for $385,000. Now imagine that over the next 4 years, that home's value rises by roughly 11%. Nothing dramatic. Nothing like the pandemic boom. Just modest appreciation. The kind that's actually below some historical averages. That same house is now worth roughly $428,000. Notice what happened. The buyer who waited didn't just lose access to the old price. He lost access to the old down payment requirement, the old loan amount, the old closing costs. Everything became larger. The higher price doesn't affect one line of the transaction. It affects nearly every line. A larger down payment, a larger mortgage, more interest paid over time, higher property taxes, even potentially higher insurance costs. The entire deal expands. And that's what makes price appreciation so dangerous for people waiting on rates. Because rate savings and price increases don't fight each other on equal terms. The price increase tends to hit first, and it tends to hit everywhere. Think about it this way. Suppose mortgage rates eventually fall by 0.5 percentage point. That's meaningful. Most people would celebrate that. On a typical mortgage, that could save hundreds of dollars every month. But now compare that savings against paying tens of thousands of dollars more for the exact same property. Suddenly, the advantage begins to shrink, and in many cases, disappear entirely. The problem isn't that lower rates don't help. They do. The problem is that people often underestimate how much appreciation can occur while they're waiting for those lower rates to arrive. Historically, that's been a difficult race to win. Housing markets don't need to explode upward for waiting to become expensive. They simply need to rise gradually. A little this year, a little next year, a little after that, and before long, the house you were planning to buy has quietly moved beyond the price point you originally calculated. Chris discovered this the hard way. Every time he checked rates, he felt like he was gathering information. Every time he delayed, he felt like he was preserving flexibility. But while he was watching the financing side of the equation, the asset itself kept moving. Not dramatically, not enough to make headlines, just steadily, month after month, year after year. And steady movement is often the most dangerous kind. Because nobody notices it until the difference becomes impossible to ignore. 4 years later, Chris wasn't looking at the same opportunity anymore. The address was the same. The neighborhood was the same. The floor plan was the same. But the numbers were completely different. The purchase price had changed. The required down payment had changed. The loan size had changed. The entire starting point had shifted. Which brings us to an uncomfortable realization. If your strategy depends on rates falling, then prices can't be rising too quickly at the same time. Those two forces work against each other. One is helping, the other is hurting. And whichever moves more wins. That's why the first assumption matters so much, not because it's the most obvious, because it's the most powerful. Most people spend all their energy forecasting mortgage rates. Very few spend equal energy forecasting housing prices. Yet in many cases, the housing price ends up determining the outcome. The waiting strategy only works if the property remains reasonably affordable while you're waiting. If affordability disappears before rates improve, the strategy starts breaking apart. And that leads directly into the second assumption. The assumption most people focus on. The assumption Chris thought would save him. The assumption that mortgage rates would actually fall on a timeline he could live with. And this is where most waiting strategies spend all their attention. Not on prices. Not on opportunity cost. Not on equity, just rates. Chris wasn't alone. Millions of buyers spent the last several years waiting for the same thing: lower borrowing costs. The logic sounded straightforward. If rates fall, monthly payments fall. If monthly payments fall, affordability improves. Simple. The problem is that timing matters just as much as direction. Being right eventually isn't the same thing as being right soon enough. Chris expected 6 months, then a year, then maybe another year. Meanwhile, life kept moving. Rent checks kept going out. House prices kept adjusting. The market didn't freeze while he waited. It continued without him. And that's the risk hidden inside every forecast. Nobody gets paid for being approximately right someday. The benefit only exists if the change arrives before the costs of waiting overwhelm the savings you're hoping to capture. In Chris's case, the timeline kept stretching. The lower rate environment he expected never arrived when he expected it. And every additional month added another layer of cost to the decision. Which leads directly into the third assumption. Because even if rates eventually cooperate, another hurdle remains. The savings have to be large enough to matter. A smaller mortgage rate sounds exciting. But refinancing isn't free. There are fees, closing costs, paperwork. Time. The savings created by a modest rate decline often take years to recover those costs. That's why many homeowners discover something surprising. A lower rate isn't automatically a better deal. The drop has to be meaningful, big enough to create real monthly savings, big enough to justify the expense required to capture it. And that doesn't happen every time rates move lower. Sometimes rates improve, but not enough. Sometimes the opportunity arrives, but not for long. Sometimes the math simply doesn't work, which means the waiting strategy depends on more than rates falling. They have to fall far enough, soon enough, and stay there long enough. 3 assumptions. Prices stay manageable. Rates decline. The savings are large enough to matter. Individually, each sounds reasonable. Together, they're a much taller order. And now we can finally see what happened when those assumptions met reality. 4 years later, Michael and Chris ended up in very different positions. Michael spent 4 years making mortgage payments. Part of those payments disappeared into interest, but another portion slowly became ownership. Month after month, payment after payment, his loan balance declined. At the same time, the value of the property increased. The combination created equity. Not overnight. Gradually, the way most wealth tends to build. Chris's path looked different. His monthly housing costs didn't disappear. They simply took another form. Rent, month after month, year after year. The money solved a housing need, but it didn't build ownership. Meanwhile, the cash he kept on the sidelines earned interest and remained accessible. That wasn't worthless. Far from it. The waiting strategy did provide benefits. Liquidity, flexibility, less risk. The problem was that those advantages weren't large enough to offset everything happening on the other side of the equation. By 2026, Michael owned an asset that had appreciated. Chris owned a larger savings account. Both had value, but they weren't equal. And that's where the experiment becomes interesting. Because instead of asking who won, we can ask a much more useful question. What would have needed to happen for Chris to come out ahead? Let's rerun the entire story. Not with different people, with different assumptions. Imagine home prices barely moved over 4 years. Imagine the same house never became meaningfully more expensive. Suddenly, the waiting strategy looks much better. Now the lower future rate has a chance to matter. Now appreciation isn't working against him. Now the gap begins to close. But that's not what happened. The house didn't stay still. Now let's hold prices where they actually went and changed the rate instead. How far would borrowing costs have needed to fall for waiting to truly pay off? Not a quarter point. Not a small improvement. A substantial drop. Large enough to offset years of appreciation. Large enough to compensate for years of rent. Large enough to erase the advantages accumulated by the buyer who entered the market earlier. The required move ends up being much larger than most people expect. And that's the central lesson. Waiting doesn't win because rates fall. Waiting wins only when multiple conditions line up at the same time. Prices cooperate. Rates cooperate. Timing cooperates. And the odds of all three moving in your favor simultaneously are far lower than the odds of any single one. That's why this story isn't really about Michael, or Chris, or even mortgage rates. It's about understanding the bet you're making. Every housing decision is a forecast. The mistake isn't making a forecast. The mistake is making one without realizing it. If you're buying today, you're making assumptions. If you're waiting, you're making assumptions too. The difference is whether you've identified them. Can you describe exactly what you're waiting for? A specific mortgage rate? A specific home price? A specific timeline? Or are you simply waiting for things to feel better? Because those are very different strategies. One is a plan. The other is hope. And hope has a habit of looking logical right up until the receipts arrive. Michael didn't know the future in 2022. Chris didn't know the future either. Neither had a crystal ball. The difference was that one decision required fewer things to go right. The other required several independent events to arrive in the correct order at roughly the correct time. Over 4 years, that turned out to matter. A lot. And that's the lesson worth remembering the next time someone says they're waiting for rates to come down. Maybe they're right. Maybe rates will fall. But that's only one piece of the puzzle. The better question is the one most people never ask. What else has to happen for that strategy to actually work? Because once you answer that question, you're no longer reacting to headlines. You're evaluating probabilities. And that's where better financial decisions usually begin.